Yo, what's up, guys? It is literally 2 a.m. for me. I should not be awake right now, but all I have on my mind is this new stock that I just bought. Do y'all ever have that moment where you just bought a new stock and all you can do is think about it and you just keep looking at their financials and stuff? Well, I just want to share with you today why this company right here, United Rentals, deserves a spot in my portfolio as a kind of stock I'm literally probably just going to buy and hold forever. No real reason to ever sell this kind of company. I'm only up 0.47% because I literally just bought the stock today. So I want to show you why I think this is an all-time amazing, incredible dividend growth company. Now they have a 1% dividend yield right here, but they basically, in my opinion, have a 5% dividend yield. So check this out. I'll kind of give you my honest analysis on them. So look at this. Yeah, they have a small 1.1% dividend yield, but look at this valuation right here, the PE ratio. They're literally trading at 16 times PE ratio, which is very fair. And then right after we look at their financials, I'm actually going to show you their investor presentation. The market that they're in, which is like renting out high quality equipment like forklifts and stuff, they actually have the largest market share. They are the largest player. But look at the net income they just made. They just made an incredible $689 million of net income. I like looking at the earnings per share because that's the net income per share. It was literally $10. So they literally made just in the most recent quarter $10 of earnings per share. And look how much the dividend cost, only $1.79. They literally just started their dividend back in 2023. So they've only had their dividend for 2 years, but look at the dividend growth. They're growing this dividend quite incredibly because they have such a low payout ratio. So they literally have around a 10% dividend payout ratio based off the earnings per share. But look at the free cash flow per share because they're also making a ton of free cash flow. They literally made $16 in the most recent quarter. So they're an incredibly profitable company. So anyway, I'll show you the numbers for yourself. They just made 689 million of net income just in the past 3 months. So just in the most recent quarter. And look at the annual dividend. It only cost $108 million. And the cost of the dividend goes up because, they're raising their dividend so much. And if you notice, actually the cost of the dividend is going down. Look at that. 2 quarters ago, it costed 110, now 109. And that's because this company is spending a tremendous amount of money buying back their own stock. So not only are you getting the 1% dividend, they spend just over 100 million on buybacks. They're spending nearly $400 million a quarter buying back their own stock. This is incredible. So if we go to the total common shares outstanding, you now own 3% more of the company than you did 1 year ago on top of the dividends. So this is an incredibly, you know, shareholder friendly company. That's why I love them. We can see the retained earnings, it just keeps on going up. It's up 18% year over year. So look at the total debt right here. So some people be like, they do have a kind of a lot of debt, $13 billion. But remember, this company, if we look at their net income, they're making over 2 billion of net income a year. So that will take them about 6 years of just net income to pay it all off. But they're in a very uh, financially healthy position. Like, look at their operating income. So this doesn't include taxes yet, but it's nearly $1 billion every single quarter. So anyway, say with the free cash flow, they're making like more free cash flow than net income. So anyway, I think this is an incredible dividend growth stock for dividends and share buybacks. Imagine this. I'm basically buying a company with a 3% dividend yield. I know one day they will switch from doing 400 million on buybacks to 400 million on dividends, you know, and that's assuming they don't grow their actual sales. And look at the stock price right now. If you're looking, for a good time to buy it, not financial advice, nothing in this video is, but now is a potential good time to buy them. And their fair valuation, I think 15 forward PE ratio, $7 annual dividend, growing dividend yield there. So $41 billion company, and they make like 2 billion plus at minimum of net income. I'll be super quick with this. So United Rentals has their general rentals, but then they also have their specialty revenue. So this company just acquired, at the beginning of 2024, they acquired a company called Yak, which is a very niche, very cool company. I'll share with you later. But look at the sales of just their specialty revenue. This is up 31% year over year. So this is some incredible growth. I do like to see that. That is now 30% of the business. That's for the full year of 2024. If we just go to the most recent quarter, it was 29% of their business. So this might potentially be like 30% of their business plus in the future. Now, if we do go to their general rentals, it is only up 3% year over year. So that's not, amazing, but still, they're incredibly profitable. That's probably why they're trading at the low PE ratio. If you're wondering, like, look at the PE ratio right here, 16 times PE. They could, if things go really bad, they could go back to maybe like this 11 PE ratio, which is where they kind of chill out. But now that they're doing buybacks and dividends, I mean, they think the stock is at a good valuation, 400 million of buybacks. Anyway, I love this company. I can't get it out of my head. All their revenue basically comes from the United States for the full year, 90% of it. Then they got the foreign. But yeah, let me know what you think about United Rentals. Now let me show you their investor presentation because this is really impressive. They just acquired this very cool company called Yak. Well, let me just run through this investor presentation with you guys. So let me turn down my brightness a little bit here. So look at this. Here's their most recent, and this is for the full year 2024. So this is the most up-to-date investor presentation. Look at this. They literally have the number one market share, 15%. So, and look at their adjusted EBITDA margin of 47%. So $21 billion fleet size. So incredibly huge company. I really like this stock. And I'm only going to show you the most important slides here. There's a ton of slides. I'm just going to show you the best ones in my opinion. So here's what they kind of do here. So aerial products, make up a good 30% of this, but then they got forklifts, which is the next big business. And then they just recently started getting into random stuff like mobile storage. And now that they do mobile storage, look at that. It's a good chunk of their business. They have trucks. They sell trucks. Look at that. Trucks are a good chunk here. Or actually, this is trucks down here, I think. Anyway, you can kind of see the different things that they do. So they are very diversified. We can kind of see all their location sites. Yeah, look at this. So we can see the residential exposure isn't much here. It's just like this right here. So I like that they don't have an incredible amount of residential exposure. I like that they do have some exposure, but it's not huge. Like they're in all these other ones, like chemicals, midstream, upstream. So, oh yeah, here, look, this is their specialty solution. So I'll show you a little later. They just acquired this very cool company called Yak Access. They own another company called New South as well, but very cool and very niche products that have a real purpose right now. So anyway, I'll get back to that a little later. But like I said, they're in portable storage on-site things. So like, look at this. If you ever wonder where all these porta potties come from, chances are they might be a United Rentals one. They're in power, they're in HVAC, fluid solutions. I'm not going to read through all this. Trench safety. So kind of some niche industries. Yeah, look at this specialty revenue. I kind of just showed you this right before here, but it's seen some incredible growth for the full year 2024. I mean, this is mainly because of M&A. Like they just bought this company back in March of 2024. But let me show you their M&A playbook down here. They have a history of buying a lot of companies, and they're seeing an incredible amount of synergies. There's a lot of important slides here that I'm kind of skipping past, but yeah, look at this. Their cumulative free cash flow in the past 5 years is $10 billion. Remember, the whole market cap right now is $41 billion. So one fourth or 25% of the entire company, they've made a free cash flow in just 5 years. You're supposed to double your money every 7 years in the stock market. This one could compound a little faster. And look at their leverage ratio. This is a very healthy balance sheet that they have. Over time, they're literally deleveraging. Right now, it's at 1.8x. So they potentially have the ability to leverage up and acquire a company if they see some kind of huge opportunity. And, they don't have any huge maturities coming up soon. 1.5 billion here in 2025. Again, they make $1.5 billion of net income in like 5 months. So that's pretty cool. Anyway, we know that they do have quite a bit of debt, but I think it's very healthy. Look at this right here. So look at their proven ability to create value through M&A. Look at the actual synergies that they have. 40 million of cost synergies, of revenue synergies. So this is very impressive. These are just some of the ones. Look at this is that 2022. Now I'll show you some of the more recent ones, like Yak right here, like we were talking about. They just acquired this one in 2024. Now they're only seeing 7 million of cost synergy. I say only. The fact that they're having cost synergies at all is a great sign. I think that they will update this maybe in 2025 where they're going to have more synergies than expected, maybe. Thompson Pump, random companies right here, Fluid Solutions, One Stop Shop. I don't know what that says. Baker Croft? I don't know. Oh yeah, look at that. They acquired this generator fleet from Cummins, which was kind of cool. So I really like their ability to create, synergies through M&A. So that's my main highlights from United Rentals. We can kind of see right here. Here's the full year of 2024 highlights. Net income of 2.5 billion, and then here's their cash from operations. It was 4.5 billion, and out of that, 2 billion of that is free cash flow. I actually like that the free cash flow isn't the same as their operating activities because that means they're actually investing in the future. They're investing, in new products and assets that'll give a good return on them, hopefully. So that's what I'm not mad about this. So the free cash flow is a little bit lower than the net income, but that's usually normal for a company. Anyway, they have some really good margins, 16% margin right here. The stock, as we saw, if we looked at the stock price, it has kind of fallen recently. The net income margin did fall 10% or 10 basis points, not much, nothing crazy. But here's the guidance right here. So for the full year 2025 here's the full year 2024 results. So let's look at this number right here, free cash flow. 2.06 billion. At the very minimum, it's going to be 2 to 2.2 billion. But look at the cash from operations. This is kind of the best number here. It went from 4.5 for the full year 2024, it was 4.5. Now at the very minimum on the low end, they have it at 4.5 to 5.1. So they're expected to grow next year. And same with the adjusted EBITDA right here. If we look right here, it was, where was it? Adjusted EBITDA 7.1. On the low end right here, it's 7.2. So their EBITDA is, of course, expected to grow as well. So that's kind of some of the good news right here. 2028 aspirational targets, 15% return on invested capital, 10 billion of adjusted EBITDA. Think about that. 10 billion of adjusted EBITDA, and right now the market cap is $40 billion. That's 1/4 of the market cap of 20 billion of total revenue. So I think that this company, because of the 3% buybacks, the 1% yield, yeah, they have some slowing growth, but they have the ability to buy other companies. They could pay off some debt and stuff, but I just really like this company. Let me know what you think about them in the comments below. I really appreciate you being here. If you did find some value in this video, I'd appreciate if you drop a like for me. It is 2 a.m. I probably missed out some context. I am really tired, but I hope you enjoyed this video, and I'll see you on the next one. My name's Nathan Robert.